Welcome everybody to another eye opener. This is Market Wealth Daily's quick little video chats that we do with top traders. And we've got Keith Harwood here. Great to have you with us. Really looking forward to a nice chat, kind of catching up. Everybody is watching this rate cut, and it's gone all over the place. It went from maybe we won't get one to now we're going to get one to now how big will it be?
Hmm.
Uh, and you have everything from it's not going to be enough to it's propping up the economy. The headlines are just all over the place.
Oh yeah.
I am turning to my favorite chart master here to kind of tone out that noise and help me take a look at exactly what we need to pay attention to. So great having you with us. Let me share the screen there and just interested in what's got your eye on all this and give
Yeah.
us some guidance on how to navigate it.
No, absolutely. I think you've nailed it with what everybody's watching right now. It's the Fed. I don't think they're going to do a 50 basis point rate cut. I think that would surprise the market and it may actually give a negative response, even though that would normally be something that people would get excited about, boosting the economy, more aggressive rate cuts. Um, Part of the problem that would happen, I think, with a bigger rate cut is then it reduces confidence in the Fed. And by that, I mean that we would end up with a situation where we say, well, we don't know exactly what they're doing. We expected them to do something. They did something different. And now that creates more uncertainty for every Fed meeting. And did they lower rates too much? And now are we going to have inflation? And all of these other things become a problem. So I think at the end of the day, they should do exactly what the market's expecting, which is a 25 basis point cut on Wednesday. The bigger
Yeah,
question may be
well,
what they say about it.
right, exactly. A lot of people would argue with you on that one, man. So many people screaming from the mountaintops that they want a jumbo cut, and
Yeah.
you know, uh, I've been doing everything I possibly can to try to just like weed out everything and say, all right, how do you just do the math on this? So what
Yeah.
are the charts telling us? Is there anything that you can see on kind of price movement that indicates what traders are actually expecting to happen?
Yeah, so well, from the stock chart itself, I think we're expecting that whatever they say, it's going to be bullish. The market's now up to a new high, closing on highs yesterday. 70 RSI usually doesn't last too long, so but with an input, maybe we get a spike. I think the biggest net result would be the perfect result for the market would be a 25 basis point rate cut with a outline of how they're going to handle the rest of the year that is more aggressive on rate cuts. So not doing 50 basis points tomorrow, but basically starting to project out greater aggressiveness on rate cuts, saying that inflation's under control, things all look really good. There's some commentary that we should have a deal with China before the November expiration. That's 2 months away. That's probably too far out to really project, given that this tariff stuff just continues to loom. But if they start showing some confidence in their projected path, that I think would be enough to get the market moving. And if they start talking about more rate cuts before the end of the year, without actually acting on it tomorrow, or for some of you watching on replay today, that would I think be the most confidence building response from the Fed. Now, if they say they were doing 50 basis points because inflation's not going to be a problem, maybe that's enough to say, okay, fine, then we can continue to go higher. But if they say they're doing 50 basis points but need to worry about inflation or the inflationary risk associated with it, now that could be a problem for the market where we can get a false breakout and then a potential pullback if they start worrying about inflation too much. And when we look at the charts, we broke out. This is a clear breakout finally. We've continued to have these attempts to break out that then consolidate and pull back. Attempt to break out, pull back. Attempt to break out, pull back. This time we broke out. The dip was even shallower, and there's really no pullback. So the market's building its confidence here. It seems like we're going into a bull mode. Now, the rate that we continue with that bull mode, again, looks like it should be a little bit slowed down by the fact that we are overbought, that people are getting more aggressive here. But that doesn't mean we can't get short-term spikes off of, a lot of this market has been buy written, which is an options term for selling out of the money calls, saying, you know, if the market rallies, I'm willing to have my stock position called away from me. If I sell a 670 call in the S&P 500, the SPY, if we go above 670, it just means I'm flat, and that's okay. But then when we go to 670, the normal reaction is, wait, I'm not long the market anymore. Now I've got to cover my calls and start getting back in, and that can actually create a bigger spike just because of positioning. So if we've got those heavy buy rates on, which seems to be the case, and we do start to see a spike, that can actually create a little bit more parabolic move. But I think those are generally short-term impacts and create a short-term top. So, we'll see how it
Well,
goes tomorrow. We'll see how it goes on
mhm,
Wednesday and Thursday and Friday. But overall, I'm expecting the market to settle into a bull mode here with an outside chance that something strange is said that causes this to be a top a la February. I mean, when I look back to the February highs that were made, we were originally going into this bull mode, barely got to a new high, and then the Fed started that pullback because of tariffs. Now, we don't have that same fear over tariffs that we had then, where there's just complete uncertainty. Now there's a little more certainty. We've gotten a lot more data. But if they say something wrong that shows some fear for the economy, we may see something scary here. Um,
mhm.
that's an outlier scenario, though. So what it really means to me is I want to still have defined risk, especially with the VIX where it's at. And I can just show you right now where the VIX is. This is the key to me for options trades. We got the VIX sitting at around 15 and a half right now. It's a little bit high. It was down around 14 and a half. A couple weeks ago, it was down at 14 and a quarter. There's been some hedging going into this event because people are a little worried. There's been some covering of those calls to get rid of the buy rights as people want to have that participation in case we get a bigger move on the Fed. But it's still generally low. And when it's low,
Yeah,
options are cheap, which means insurance is cheap and leverage is cheap. So we're at a
right.
pretty low point here, and that can create some opportunity to make sure that I've got my risk defined just in case.
Yeah. There's a lot of things pointing to this continued stair step. We might see a little bit of a wider move after the
Hmm.
announcement tomorrow. But the steady crawl upward, there hasn't been much. It's been almost bulletproof. I mean,
Yeah.
so many things coming up in the headlines, and it just keeps shaking them off. Know that there was just so much attention paid to this. The thing that everybody has to remember is it gets a lot of attention because of headlines. Headlines, in my opinion, have changed over the last few years, where headlines are really designed to get clicks and not as focused on what's in the material. So
Mhm.
they're looking for, it's the reporting on a weather event. They know that's going to draw people's attention and bring them in. Right now, the rate cut announcement is a weather event, and it's drawing people to read those articles. So they're hyping it up more. There's a lot that goes on behind the scenes to make that call on that rate cut, that
Oh yeah.
what's going to happen. I I'm you obviously this is a very key point. You've got to be cautious. So here's the question: do you trade into it, or do you step aside, let it move on, get back in, Thursday?
That's a tough choice for a lot of people, right?
Yeah.
For
And
those,
it's not necessarily one or the other,
yeah,
because there could
exactly.
be a trade that, covers you, over this, but it's not the trade that you would take if it was any other day.
Exactly.
So,
Yeah, so I think that the general approach that I'm taking is to say if I'm not going to define my risk, then I don't want to be in.
mm,
So if I don't want to have a clear stop near the market right now because the market can pull back, and right now the clear stop is 650 in SPY. So, 2%. Or sorry, yeah, about just under 2%. That's not too bad of a problem. And now executing it is the key because right now, what's been happening in these dips is that they've all been buying opportunities. So if I set the game plan that if we go back below the previous high that was our breakout level, that I need to get out, I actually have to do that. If I want to be able to buy a dip, then I either have to use options to hedge my position by buying a put, or I have to have enough cash on the sideline that I can buy a dip. And if it's bullish and I'm comfortable with it and it's not too crazy, like we don't go straight to 680, then maybe I can buy in still. But there is that FOMO issue. If I didn't buy something today and then the market starts to rally, Am I going to get frustrated and make a bad purchase because of the psychological impact, the psychology part of saying, well, I just missed out on 3% because I wasn't in when the Fed said what I was expecting. So, having something on the long side makes a lot of sense to me. Having something to hedge it makes a lot of sense to me. If I'm not hedging it, having a stop out and accepting that I can take a small loss, even if we're going into a bull market where a dip can be bought, because these dips have been shallower and shallower. The dip was down to 620, the dip was down to 635, the dip was again down to 635. Now the dip was only 645. Every dip has been a naturally trained buying opportunity, really since April, right? Every dip has been a buying opportunity where we've gone a little bit higher on the low and a little bit higher on the high. Um,
Hmm.
and missing out on it is frustrating for people. It puts you on tilt for those that like poker, where you say, okay, well, now I'm going to just start making trades that maybe don't make a lot of sense and don't have the high expected value because I missed it all the way up to here. And I hate
Emotion.
being in a
You've,
position where I'm going to set myself up for a bad trade, even if
yeah.
I don't have one on today.
Yep. Exactly. Right.
So I think
Well,
that there's a natural inclination here to say be long. If we get below 650, maybe get out or reduce. And then if we keep falling, continue to reduce and or look for the bear side of things in case the Fed says something drastically concerning, which
gotcha.
would be unexpected, but has happened. So
Yeah. So how does that look? What are we pushing the button on?
yeah, so one of the things that I've been kind of focusing on recently is that, tech has started to get some more leadership here. QQ, this is the Russell value. I missed a Q here. Let's pull up QQQ instead of the Russell value. QQQ has started to generate some leadership here. People have started to go a little more heavy into the risk, right? And so tech has shown really good strength here. Last few weeks, closing above the open. So that's a lot of good money flow during the day, and in particular, semiconductors. A leading indicator for tech has been really strong. Semiconductors have broken out here. We've had names like, AVGO, really positive. Had great earnings and then just continuing here to the upside. So when I see some of this sort of stuff, it starts to give me more confidence that, maybe I can go into the tech space, which I've kind of been avoiding because tech is that, who knows. But when tech starts to get, when we start to see interest rates getting cut, that actually helps benefit tech. Lower interest rates means cheaper debt. They can raise the money that they need to grow. Um, so I did my kind of normal stuff here, and I went over to the stock forecast toolbox, and first thing I looked at was SPY. And the model says maybe we get a little bit of a dip before a rally. Okay, so kind of what we've been seeing, right? A little dip and then a rally. When I go to QQQ, I'm looking at a potential for a little consolidation before a rally. That gives me more confidence in the tech space that AI is seeing that money flow the same way that I'm seeing on the technicals. And similarly, SMH, semiconductors, showing a bit of consolidation here, maybe because they've had so much rally already, but not major downside, maybe a percent. That's not huge for semiconductors, to be clear.
Mm.
But I go through with my forecast toolbox, and I went through like the company screener here, and I was looking for some names that had good, positive, high graded predictions. And one name caught my eye because it hasn't participated nearly as aggressively during this tech rally, and that was NVIDIA. So NVIDIA has been broadly less of a focal point for this market. And yet NVIDIA now is starting to show signs that maybe there is some rotation into NVIDIA. This looks better than almost any of these ETFs. It looks better than SMH. It looks better than QQQ. So if QQQ is getting some bullish flow, and people start to go back to what's worked in the past in tech, and NVIDIA comes to mind as one of the top ideas, right? And there's this shot that NVIDIA can spike up. So if NVIDIA has that potential, and it's not nearly as overbought as a lot of other elements. We've got a 55 RSI. It's got room. There is money that can go into NVIDIA. So I've also got a benefit here of Nvidia having very briefly dipped below the 50-day moving average, but generally using that as some support here or a price point of around 172 and a half. Looks like a pretty solid support level. So I can really well define my risk at about 3% of the stock price and say, okay, well, if the stock pulls back 3%, then it wasn't ready. The market wasn't ready and it's time to go. But if the market's going to break out, I just don't see a world where Nvidia is not part of that rally and probably goes to new highs in that scenario. So yes, there
Well,
should be some resistance at 185, the previous high, but how strongly can that hold if the market's going to go full bull mode here off of the Fed?
yeah, it's interesting. So tech, looking kind of, high level, zeroing in, and identifying the tech and setting up for a consolidation as opposed to a pullback.
Hmm.
Really interesting stuff. Using the toolbox is, the thing that I really get excited about when we're on these calls, taking a look at
Hmm.
what that's showing us. It's a toolbox, and the definition of a tool, it has a great application, be used for a lot of different things, but typically it's really good for one thing. The having the right tool for the job is important.
Hmm.
What the toolbox does for me is it doesn't read headlines. It's not looking at what, some pundit, sitting on a keyboard typing the next article on Yahoo Finance or something like that is looking at. It's looking at what traders are actually doing. Don't, you know, let's look at what they're doing and not what they're saying. And
Hmm.
it uses all of those data points way more than I could possibly process.
Yeah, yeah,
And it's starting to get a sense of what's going to happen. So now you take that and you say, all right, if there's a consolidation, which is the stock in that tech group that has the most potential?
yeah,
And that's where you go back to kind of coupling that toolbox with the experience and the expertise that you have to
yeah,
say, all right, this is kind of what I see happening. I got into the right area, into the right group of stocks. Now let me look at which ones are really starting to show the biggest promise. So, if you guys are logged on right now, I'd love to have you type in and chat and just let us know if you are in the market through this rate change or if you're going to sit on the sidelines. Because,
yeah,
getting it, Keith and I can talk about this all day, but I'm really interested in where you guys are at. So I'm pretty sure I got the chat set up there.
yeah.
Go ahead and type in. Let us know if you're in or on the sidelines. Be interested to hear where you guys are at. So, with this NVIDIA chart setting up like this, what's the option strategy that you look at for this? Obviously, I think a directional uh, position is probably a little bit not the best use of options in the current market, but I could be wrong on that. That's for sure.
Yeah, so that is the ultimate question, right? I mean, I was torn, to be fair. With Nvidia, when I look at it, I say, okay, well, I feel pretty confident that it's going to hold that support level as long as the market doesn't go into liquidation mode. So that would naturally lean me towards a put credit spread. And that's my general preference here is a put credit spread because I can say if I sell an out of the money put credit spread, I don't have to go to new highs. The market can consolidate for a few days and I can still make some money. I can collect theta. As long as the stock doesn't go down, I'm in good shape. Now, the forecast toolbox maybe is setting up for something a little more bullish, like an outright call or a call debit spread that has a little bit more leverage. Um, and I was so tempted by it, but with that 70 plus RSI for the broad market, I get too concerned that we just have that consolidation coming. So for me, I think that the put credit spread makes a little bit more sense here. And when I do a put credit spread, I'm selling a out of the money put, but I'm buying a lower strike put. So I have a natural stop to my position. And there are sort of two ways I could implement it. And I usually focus on the level that I think is support. So 172 and a half for me is that support level. If I go out and just sell the 172 and a half put and the market goes into liquidation, I've got huge risk. I don't want to just sell that put. I want to buy a lower strike put in case we go below 172 and a half. So I could either look at selling a 172 and a half, 170 put credit spread in case of liquidation and collect about 57 cents. Or actually, in this case, like being a little bit more aggressive and selling a 175, 172 and a half put credit spread. I get a little bit more premium, 76 cents based upon yesterday's close. And we're actually a little bit weaker today. So maybe closer to 80 cents this morning. Um, in that scenario, If there's liquidation and I just can't get out, the max value of that put credit spread turns to $2.50. And yes, I lose $1.70 for something I was expecting or looking to make 80 cents. But if the market just holds, rallies, does anything other than go down, I end up making my 80 cents. If I wanted to go on the bull case and shoot for 195, certainly I could do that. I'd usually add a little bit more time. I go to like an October 185, 195 call vertical. It's $2.50. It could go to as much as 10. I can multiply my money, but I just feel a lot more comfortable and a lot higher probability of success, excuse me, by saying I don't want to bet that this market's going to go parabolic to the upside. I'd rather focus on just collecting a little bit here, making a bit of money, having it leveraged to a certain degree, but having my risk fully defined. And if the market liquidates and we drop, maybe I end up getting out of this put credit spread for a buck and a quarter or a buck 40 or a buck and a half. And now my risk and my reward are actually a little bit closer to equal and or maybe even less risk than reward. I only have to hold for about a week, week and a half if I want to go all the way to expiration. And I can generate a decent return here, risking a buck 70 to make 80 cents, but in practice, more likely risking closer to a dollar to make 80 cents.
I really like the approach of planning for the paycheck as opposed to buying a lottery ticket.
Hmm.
It definitely is the long-term, smart trader kind of move of let's just get our income, let's generate money, put money in the
Hmm.
bank every time. Glenn chimed in. I was asking if people are going to be in or be on the sideline, and he says he's in tech and the gold market, which the gold has just been on fire.
Yeah.
So it's interesting to see. I always when I actually can't filter out my emotions, some of these levels with stuff just going straight up scares me. I mean, I get fear of
Mhm.
heights a little bit. Like, man, if it's going up, it's going to come down. But I've been on these chats with you enough to know that that's momentum, and it
Hmm.
doesn't mean that it's weak momentum. If it's strong momentum, there could be opportunity there. So, hey, Glenn, thanks
Yeah.
for pointing that out, man.
Yeah, no, and gold is one that I've been reluctant personally. So I've missed this move in gold. I thought that gold was going to get a spike and then a pullback. I was wrong. Um, didn't participate in either direction. Thought there would be a bigger pullback, and we did try to have a pullback on
Hmm.
the 10th, and then bounced right back.
Yeah,
One other name that actually came up on the forecast toolbox was NEM, which has been grinding higher instead of spiking higher. And this is a minor. It's got gold, it's got base metals as
mine.
well. Um, I had looked at that one as a potential for today as well. Really strong model grade, really nice, clean looking trend to the upside, 6-7%, just continuing to show expectation of continuing what we've been doing. That's a spot where I like going in for the precious metals market if that's the goal, because we've used this 10-day moving average as support the whole way up. So I'm defining my risk not based upon where we consolidated last down to the way at, sub $70 a share, but really close by at 77. And that's the way I would be looking at like an NEM or a gold type trade. But given that I've kind of, and again, been wrong, I'm still not sure I believe in the gold move here personally. Even though the charts probably say good, my psychology on it just says, I don't know if I trust it. Well, I probably should trust it, but I can't convince myself to trust it. So I have to let it go because if I can't trust it, then I'm not going to have the confidence to hold into a trade that I just have something in my head saying, something feels off. I'm not sure I love it. I don't want to go for it, so I got to avoid it. But those that have that confidence, I think, can go into an NEM and look at the same sort of structure. A put credit spread, 77 being a hold point. Let's see if the prices are still updated here. Now we lost the prices because we got too close to the open. But the 77 put, let's see if I can get the price from yesterday's close. Yes. So those closed out around 92 cents. The 76 put closed out around 76 cents. So, it's a low return on capital. It's about 16 cents for 84 cents of risk. It's not actually nearly as good of a ratio on risk versus reward as Nvidia. Um, but it could be a way to participate in the gold market, again, collect a little bit of a paycheck and look for an opportunity there. I think Nvidia's got a better risk reward profile overall, and it hasn't hit the trend yet. Um, and that's kind of why I said, I think I want to focus on the tech side of things as well. I got more confidence in tech than I do in gold. Um, and we haven't already gotten into the full trend mode yet for NVIDIA. And when NVIDIA trends, you can see it, from really May and then through August, 2.5 months, 2 to 3 months of just nice, stable upside maneuvering. And when we didn't go up, well, we also didn't really go down. So if NVIDIA is going to be if the market's going to be bullish, I just don't see NVIDIA being in liquidation mode. And if the market's going to be sideways, I think NVIDIA stays sideways. And if the market does go into liquidation mode, I'm sure NVIDIA has to participate being a, $4 trillion company. It's hard for it to not go down if the market's going down.
Yeah, interesting, interesting. Well, let's just hope, Glenn, I hope that the goal keeps working for you. Hope it pays
Mhm.
out. I hope that the tech move that we're looking at is the right one as you go through this rate announcement. We're going to be dialed in. We're going to be giving everybody updates, and we're going to
Yeah.
get Keith back here, and we'll take a look at not only how this all played out, but what's going to be coming up next. Keith, thanks so much for taking the time. I know market's about to open. We all want to jump and do our thing. So thanks everybody for being in the room. Carlos, great to see you again, my man. Love having you in the room with us. All of you people, great trading today. Be smart, be wise, keep learning, and Keith, thanks again.
Thank you, John. Thank you, everybody.